Dustin, good to see you. Today we are talking through phantom income and its scary tax implications. Few things sound scarier than phantom income. You would think any kind of income would be good, but this one and the taxes that come with it can take a lot of investors by surprise. So, what is phantom income?
Yeah, so phantom income, when it comes to investments, what we're talking about is a situation where you've realized a taxable gain, even though you never sold an investment.
So, you're on the hook to pay taxes on money that you never actually received.
That's right. So oftentimes the most common example of this is when you own mutual funds in a taxable account.
Mm-hmm.
So we're not talking about the mutual funds held in an IRA or in your 401k, but just mutual funds held in a regular brokerage account. Okay, the tax treatment of those mutual funds is different than other investments. So even though you might not have sold your shares of that mutual fund, if other investors sold shares of that mutual fund, in order to redeem those shares, the fund manager has got to sell assets inside the fund. And if any of those assets that are sold had unrealized gains, those gains are going to be distributed across all shareholders. So
That
whether
is
you
good.
sold or not, you can end up with a gain, and that comes with taxes to pay.
I know you focus on strategic tax planning. So, how do we avoid phantom income?
Yeah. So one of the easiest things to consider is, hey, if we're talking about a taxable account, let's consider allocating to exchange traded funds or ETFs rather than mutual funds. Um, the reason for that, ETFs in general, uh, there are little to no taxable events for the fund holder is for the investor as long as that fund is held. They trade like stocks, and like stocks, the investor only tends to realize a gain once they make the decision to sell.
Mm-hmm. Are there any other strategies to avoid phantom income other than considering ETFs instead of mutual funds?
Yeah, I'd say a couple of things. So you want to make sure you've got the right investments in the right accounts. That's not just important for phantom income. That's important for any kind of taxable income and tax
Right.
considerations. But you want to make sure, if we're talking about, again, mutual funds, if we're talking about actively traded strategies, if we're talking about bonds that throw off interest. So those types of investments, because they're going to be less tax efficient in a taxable account, you want to consider holding those inside your IRAs or your 401k, your retirement accounts. Well, they'll be tax sheltered.
Mm.
When we're talking about taxable accounts like brokerage accounts, uh, that's where we really want to consider exchange traded funds and stocks, because those instruments are going to be much more tax efficient when held in a taxable account.
Okay.
The other thing that you'd want to consider, just because we said in general ETFs are more tax efficient than mutual funds, it doesn't mean that there aren't tax efficient mutual funds out there. If you want to use mutual funds inside a taxable account from a tax perspective, we would just want to look for mutual funds that have a history of low distributions and low turnover to
Mhm.
limit that exposure to taxation.
Dustin, this was a lot to absorb. If somebody would like to talk through then kind of their tax liability and whether they are positioned properly, what's the best way to reach you?
They can text me a question at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
Great. Dustin, thank you.
Thanks, Aaron.